Welcome back to the Group Practice Accelerator podcast, brought to you by Polaris Healthcare Partners, where we leverage decades of healthcare and business experience to drive growth in successful group practices just like yours. If you're a healthcare entrepreneur and you're interested in building, scaling, or exiting your group practice, you've found not only the industry's leading resource for business education, but a team of trusted advisors dedicated to helping you achieve and exceed your goals. In short, the team at Polaris creates clarity, confidence, and results. I'm your host, Jamie Falash, and the Group Practice Accelerator podcast is on the air. So, as you know, if you've been tuning in lately, we have some great additions, changes, announcements, and things like that for 2025. And as part of that, we're going to be providing market updates. Our listeners and clients lean on us for this kind of info as they make transactional decisions for their businesses. So we know that many of you want to stay on top of really anything we might be taking from the tea leaves. So we'll share those updates on a regular basis. And with that in mind, joining me today is my teammate and Transaction Advisory Executive, Kyle Webster. Hey, Kyle.
Hi, Jamie. Thank you for having me on.
Sure. Kyle and I are going to go back to some basics on a topic that's really closely tied to the market, obviously, and that's around rollover equity. And when I say back to basics, what I mean is that today's conversation will kind of be tailored to those who are starting to consider their options in terms of sale, those who aren't 100% certain about what they want out of a deal just yet, or even those that think they do. But more specifically, what staying on for a period of time looks like, including how their deals could look in terms of structure. I know it's a lot to cover, but I'll let our resident expert take the reins as he's done for many Polaris clients before. Kyle, welcome back to the show. Good to see you again.
Absolutely. Like I said, excited to be back. As you said, leading into 25, we do have a new market update for the listeners. I think the general theme that we're going to be coming back to is optimism. As we've started the new year, we've seen a lot of research outlets reporting that the PE sponsors, the groups that support many of our DSOs, have been a lot more optimistic about recaps in 25. And that's going to be both from an IPO perspective and also a traditional buyout perspective. And that optimism is trickling down to the development teams that most of our doctors, our group practices are going to be interfacing with when looking at a sale. And in conversation with a lot of those buyers, the loosening of some of the credit restrictions is going to allow them to be a lot more aggressive in the market, a lot more active in reviewing opportunities, and really putting the sharpest pencil down when getting offers out.
Oh, that's great. Hey, and always good to hear that things are on the upswing. But like you said, there are some things to look out for, things to be cautious of, and like you said, deal structure is one of them. So we want to kind of jump into the conversation with that in mind. And we're talking about rollover equity. I know last month you stressed that there are, a ton of unknowns and decisions that docs will run into as part of a transaction. So realizing we have listeners who are very familiar with deal structure, but maybe some that aren't, and just dipping a toe in the water, it's a huge life change, and just a decision that nobody takes lightly. So, what I want to do is kind of lead in with some of those fundamentals, because I know we're considering a sale in any form. It's easy to get into the weeds, so I kind of want to back out of that a bit. So I'm going to ask you a really basic question. For us, it's basic, but we have to remember that if someone's just getting started in this process, they need the full education, and we can kind of give a little glimpse of that. But can you tell listeners from your perspective and your experience a little more, and just go into exactly what rollover equity is?
Sure. On the podcast last month, we talked about how there are a million different little details in a transaction that can be the difference between really maximizing the outcome of the deal or leaving significant dollars on the table. And I think we're going to get into a lot of those different levers over the course of the year. But one of the most important, and something that we talk with our sellers about almost every single transaction, is the concept of rollover equity. And really, basically, in its simplest form, rollover equity is a form of proceeds where you retain investment in either the practice that you're selling, or where the term rolled comes from, you roll it into the buyer, into their entity at one level or another. Rollover equity is a key component of dental deals in most DSO, MSO roll-ups. It is a way that the larger organization can really, maximize the outcome for the seller. And it allows them to purchase, a little bit more EBITDA by loosening some of the credit requirements that they might have. Rollover equity is a vehicle that allows the buyer and the seller to have, continually aligned interests post-transaction. And again, it is, principally a vehicle for appreciation, right? You make that investment, you roll those dollars with the intention of it to grow substantially. And that really is, when it comes down to structure and maximizing your deal, ensuring that the guardrails and contracts are all in place to, for the seller to be able to realize those dollars is a key part of what we focus on.
Yeah, absolutely. And, it's a great option especially if you're looking to stay on, in some kind of capacity. And we know there are a number of ways you can do that as well. And with any type of deal, we have to consider the pros and cons, right? So what works for one is not going to work for another. So can you walk through just what some of those pros and cons are?
Absolutely. So the pros are relatively straightforward. A larger rollover equity position allows the buyer to pay a premium for your practice. Being a non-cash form of proceeds, it reduces some of the lending restrictions that might, be a pressure on the buyer, might be a limiting factor on what they can pay. And it also reduces the risk for the buyer. Because you, the seller, and the buyer's interests are now aligned, they can really afford to, put their best foot forward, approach their maximum offer because they don't need to write it down to account for that risk. For the seller, the pro essentially is that larger proceed, that larger value at sale, but also the ability for that rollover equity to grow. Whatever level it stays at within the buyer can determine, the growth rates and, when you're able to cash out on those dollars. But really being able to take advantage of, an appreciating asset as part of the sale gives the doctor, what we call a second bite of the apple, and another opportunity to capitalize on what would otherwise be a once in a lifetime investment.
Yeah, that makes sense. And I know that's an attractive option for a lot of people. And we know that, the more equity you're rolling in generally means a higher multiple, correct? In most instances. Can you elaborate on that just a little bit for us?
Sure. So as I said, it comes back to, lending restrictions, right? Every DSO, every buyer is going to have a, set of covenants that they have to abide by when making acquisitions. And, in order to be as aggressive as possible in the space, frequently these buyers are going to be kind of running up against those guardrails. So they may reach a ceiling of what they can offer to a seller in the form of cash. Rollover equity is a form of proceeds that isn't going to be restricted by those guidelines and gives them an ability to, offer upside, offer proceeds to a seller that is kind of outside of those guardrails. And that is really one of the ways that sellers are going to be able to achieve a premium on their practice. Compare that to a doctor-to-doctor transaction where, an equity vehicle may not be available. The differences in valuations between, a doctor-to-doctor deal or a group practice deal start to make a little bit more sense.
Yeah, and it's a complicated decision. There are a lot of factors that go into that. Like what's important to you personally, and that's a layered and complicated answer. And at the end of the day, do you need cash now? Can you afford to ride that wave? What happens if I get into a deal where, I decide that I don't want to be part of that deal anymore. So there are a lot of things to factor in, and I know that you go through that whole list of potential scenarios with our clients. So I don't want to give away, too much of the secret sauce because there's a lot that goes into that, and it's not a single sentence answer. Or we could spend hours talking about it, right? There's a lot that goes into it.
I certainly don't want to paint a picture as though rollover equity isn't without risks, right? It is an investment. It is a kind of a hitching your cart to the buyer's wagon. And those risks are something that, need to be evaluated and kind of weighed against the pros of rollover. So, working through what makes the most sense for a seller is really a kind of a complex equation where we look at a lot of different things, your your stage of your career, your cash needs, if there's debt to be cured. And all of these things are going to be kind of added up and used to, decide if rollover equity makes sense, where it makes the most sense, and really what risks that come along with it can be mitigated or not. Ultimately, the structure of the equity and where it sits is one thing, but there are a lot of tiny details that come along with rollover equity, vesting schedules, employment agreements, a number of tiny little details that have to be fleshed out to make sure that that option truly is in a position to be maximized. When we talk about structure end of a deal and negotiating, we often say, structure beats price. It's one of the mantras of Polaris. And this is really one of the areas where that is, true more than ever, right? If you want to have a deal where you've truly maximized the potential of the outcome, negotiating the structure to be in its optimal position to extract value is really key when it comes to rollover.
Sure, because all of those tiny points add up to, potentially big money left on the table. And
Exactly.
nobody wants to walk away with money left on the table. So, if I'm looking at selling my practice, I think I want to stay on, 3 to 5 years, not sure yet. And you're going to take me through some of that, if I'm going to give you a call. But can you go through what some of those options or levels would look like? And how do I know what's right for me?
Sure. So generally, the options that are available to you are going to depend on the buyer, but there are two very common, kind of universally used levels. It's the holdco model, where equity sits at the same level as the institutional investors, the private equity firm that owns it, the founder who started the first practice. That equity sits at one level. That's called the holdco. Every practice that group owns is going to support that equity's valuation and kind of feed it.
Right.
The other very common model is what we call a JV model, and that's where that institution, that group, holds interest in levels below it. That's a joint venture essentially between that DSO or the group and each office. So a joint venture, a JV model, can be each JV is one office or one group of offices that share branding, and really everything in between. So if you're looking at a JV model, it may be each transaction that DSO accumulated has its own JV. It could be by region. It's really just a way of looking at the DSO as segmented by some criteria rather than a top level that everyone participates in. Really deciding which of those makes the most sense for you is kind of part of that broader equation. And there are things that may make one more appealing than the other. Generally speaking, when we talk about holdco equity, the real pull is that you're able to diversify your risk by taking performance from offices other than the one you're selling, and kind of capitalize on the pull of everybody or the improved performance of everybody. But also, you're able to leverage the support services, the additional lending capabilities, the expertise that comes with the C-suite of that DSO to get returns that a single office or small group might not normally be able to do. And we generally have seen that to be true. The DSO holdco model does tend to outperform, an average solo office or solo JV. But if you were in a rapidly expanding demographic, your office was, exploding, growing 30, 35, 40% per year, and you wanted to make sure that, you were able to still take advantage of the growth of your individual practice, post-sale, JV equity might make a whole lot of sense. If you were, extremely adverse to someone else driving the ship, and you wanted, your practice, your hard work ethic to be the thing that drives your returns, JV equity might make sense for you. Really, the answer there is that there's no one size fits all, and kind of going through this list of questions, understanding really what a seller is looking for out of a transaction is going to help kind of narrow us down or point us in the right direction. The other thing that is becoming more common is that it doesn't need to be one or the other. Oftentimes we are able to leverage one or both of these levels of equity to get sort of a tailored approach. One thing again that I think we're going to see in 25 is a little bit more creativity when it comes to deal structure, a little bit more of taking advantage of some of those reduced requirements. So I think as we look at what options are available, I would expect to see that list grow in 25 and see the options that are put in front of us continue to expand.
Well, that's good news for a lot of people, I think, because that optimism towards creativity of deals gives people a lot more freedom to get what they want. Do you want to stay in the driver's seat a little bit more? Are you ready to, to call it quits in X number of years? But I like that we're going to see a little bit more of that. So we appreciate that along with the market update. We'll wait and see what happens, but there certainly is room for growth in that creativity department. I want to shift gears a little bit to your personal experience with, I know you do a ton of deals, but can you maybe hone in on a couple that where things went really positively? Like what's an ideal scenario?
Well, I think the ideal scenario when it comes to a rollover or structure of a deal is that you, at the end of the day, at the end of your initial employment agreement, whenever you choose to retire, when you look back on the transaction, is that you got what you signed up for, right? What was on the paper is what translated to, you in form of proceeds or outcomes. Things are what they were expected to be. I think that there are a couple of standout transactions that Polaris has negotiated over the years. We were able to deliver, really outside of market, wins for our clients. Some that pop to mind are, getting our selling doctors, $1 equity from a holdco perspective. Having them be able to participate as early as possible in the formation of a DSO, and really kind of go along for that ride. Ultimately, if you look at any investment, the earlier you get in, the greater your chance of return, and that's certainly been true for those doctors. But
Absolutely.
more than that, I think that our focus, with every deal, is approaching rollover and structure in a way that is so detail oriented that we put our clients in the best chance possible to really get everything that they signed up for. And when I talk about or think about success from a rollover standpoint, that's what I'm looking for from my doctors. I want to provide the greatest level of clarity and the optimal or the greatest potential for an optimal outcome as possible. Really put them in a position where they have the opportunity to pull every dollar they can out of this transaction. Because for many of them, they're only going to sell their dental office once. We really want them to be able to capitalize both on the front end and in the context of rollover equity on the back end. We talk about these vehicles being an opportunity for a second bite or another return. Most DSOs are targeting a 3 or 5x return over 5 years, which is also a very common initial employment agreement term. So when you look at this, at the end of that term, when the DSO is able to execute, when you've put a structure in place that's mutually beneficial, you're talking about a second bite of the apple that can be more often than not worth more than your initial deal. That's a win-win structure. That really is the kind of optimal outcome that we're shooting for every time.
Yeah, and when we talk about ideal or optimal outcome, that's really subjective, right? It's got to be based on what you want, what's your vision. I mean, this is your life's work. So you have to have some idea in mind how you want things to go, how you want this to look at the end of the day. And, is it more time with your family? Is it a leadership role, when you're in that new position after sale? So it all depends on what you want, what you're looking for, and what your end game is. So we appreciate the insight here. And I know there's a lot more layers to uncover. That just needs to happen with a conversation with you. We don't have time for all that today. We'd be here for weeks on end, of course. Thanks, Kyle. We appreciate your expertise as always. And we look forward to your next market update. And we'll get into another topic that we hear a lot of questions on. So once again, thanks for joining us for another episode of the Group Practice Accelerator podcast. To continue this conversation, learn more, or just explore your transaction options, you can get in touch with Kyle by dropping him an email to kyle@polarishealthcarepartners.com. Or if you want to schedule some time to learn more about any of our many expert advisory services, you can drop us an email to info@polarishealthcarepartners.com, or as always, you can reach us on that website at www.polarishealthcarepartners.com. Thanks so much for being a loyal listener and subscriber. If you enjoyed today's episode, leave us a rating on Apple Podcasts, Spotify, Stitcher, or wherever you get your podcasts. We'll see you on the next episode of the Group Practice Accelerator Podcast.